Welcome to Chapter 16, Turnover Ratios. Here we'll go over 7 ratios that tell us a lot about how the business is running. The following 7 ratios do not solve any problems, they identify them. With turnover ratios, we are typically comparing one earnings statement value to one balance sheet value to see if those asset values are efficient. We will take them one at a time from ratio 13 to ratio 19. The analysis involved using these ratios is truly powerful. They are cost of goods sold divided by inventory, revenue divided by accounts receivable, revenue divided by total assets, cost of goods sold divided by accounts payable, number of days sales in inventory, number of days sales in accounts receivable, and finally, accounts payable turnover ratio. On this slide, we are looking at ABC's balance sheet once again. Some subtotals we can see: current assets, $350,000, fixed assets, $300,000, total assets, $650,000. Current liabilities, $150,000, long-term debt, $175,000, total debt, $325,000. Equity or capital is $275,000. Total liabilities and equity, $650,000. Before we calculate the ratios, let us have another look at the earnings statement. Sales, $940,000. Cost of sales, $620,000. Gross margin, $320,000. Operating expense, $264,000. Earnings before interest and taxes, $56,000. And net profit, $35,000. Our first turnover ratio, ratio number 13, is cost of sales divided by average inventory. The question we ask is, how many times did inventory turn over in a year? Here from the earnings statement, we see cost of sales, $620,000. Here we have the analysis of cost of sales showing beginning inventory of $120,000 and ending inventory of $160,000. $120,000 plus $160,000 equals $280,000. Divide by 2 gives us average inventory of $140,000. Cost of sales, $620,000 divided by average inventory of $140,000 gives us a ratio of 4.3 to 1. We see that we have only turned over the inventory 4.3 times. The industry standard is 7 to 1. The budget for inventory turnover is 7 to 1. If cost of sales is $620,000 and the standard is 7 to 1, then 620 divided by 7 equals $89,000. That is the budgeted inventory. Our average inventory is $140,000, and the budgeted inventory at the current cost of sales is $89,000. Accordingly, excess inventory is $51,000. Now the question becomes, what does it cost us to hold an additional dollar of inventory? 1. Cost of capital. Either money borrowed or investor contributions costs about 10%. 2. Obsolescence, another 10%. Could be more for technology products or seasonal goods. 3. Storage and handling, 2 to 5%. 4. Insurance, 2%. Altogether, about 25% per year. Now take 51,000 times 25%. That's $12,750. That is the cost of our excess inventory. Consider the company only made $35,000. And here with this first turnover ratio, we identify $12,750 as waste and loss. The accounts receivable turnover ratio is sales of $940,000 divided by accounts receivable of $130,000. That gives us a turnover of 7.23 to 1. Now, if we are selling on 30-day terms, meaning we give customers 30 days to pay, then accounts receivable should turn over about once a month, or 12 times per year. This turnover standard is based on the credit terms, not on any industry-specific benchmarks. The standard for accounts receivable turnover in the U.S. garment industry is 10.2 to 1. Take 940,000 in sales divided by 10.2 equals 92,156. That's the budgeted accounts receivable. Our actual accounts receivable is 130,000. 130 minus 92,000, 156 equals 37,844 in excess accounts receivable. Here we see cost of goods sold on the earnings statement, 620,000. Now let's look at return on assets. This ratio tells us how much net income is being generated for every dollar of total assets. Net profit is 35,000. Total assets are 650,000. The standard for a clothing retailer is 8%. Our actual return is 5.4%, suggesting a below standard outcome. If we were meeting the standard, 8% times 650 equals 52,000. That would be the budgeted profit for the company. In this slide, we see the lower part of the balance sheet, showing total assets of 650,000. Now we move to another turnover ratio, cost of goods sold divided by accounts payable. We're looking to see how quickly we pay our vendors. Here, 620,000 in cost of goods sold, divided by 60,000 in accounts payable equals 10.3 to 1. The standard here is 12 to 1. This standard is not based on the clothing industry, but on general 30-day payment terms. Even though our number is below the standard, 10.3 is still reasonable and suggests that accounts payable is being managed well. Here we see cost of goods sold on the earnings statement, 620,000. And here, accounts payable on the balance sheet listed as 60,000. Now we look at ratio 17, the number of days, sales, and inventory. This is inventory times 365, divided by cost of goods sold. This ratio tells us how long inventory sits before it's sold. It gives us insight into inventory efficiency. In this slide, we calculate the number of days, sales, and inventory. What is that? Well, what we are doing is comparing our average inventory times the number of days in a year to cost of goods sold. Average inventory is 140,000. Multiply that by 365. Then divide by cost of goods sold, 620,000. We get 82 days. That's 82 days inventory sits before it's sold. The standard is 52 days. This means inventory is moving too slowly. A typical clothing wholesaler turns inventory in 51 days. ABC Company takes 82.4 days. At our current cost of sales, the standard inventory level is 89,000. We calculate that using 620,000 divided by 365 over 52. So actual inventory is 140,000 and the budgeted level is 89,000. That's 51,000 in excess inventory. Now multiply 51,000 times 25% and we get a cost of $12,750. In this slide we show cost of goods sold again, 620,000, used in our turnover and efficiency calculations. Next we calculate the number of days sales in accounts receivable. We take accounts receivable, 130,000, multiply by 365 and divide by sales of 940,000. That equals 51 days. The standard for days sales in accounts receivable is 38 days. Even though we sell on 30-day terms, the world doesn't always pay on time, so 38 days is a more realistic benchmark. Just like with inventory, excess accounts receivable comes at a cost. That cost includes 10% for cost of capital, 5% for credit management, and another 10% for bad debts. Total, about 25%. And yes, we already made this calculation earlier when we analyzed accounts receivable turnover. Let's consider the reasons why a company might carry excess accounts receivable. Reason 1, a flawed credit management system. Maybe we extended credit to financially weak customers. Reason 2, we're not proactive about collections. Active management means dialing for dollars every Monday morning. Reason 3, our product offering isn't in strong demand, so customers take their time paying us. Reason 4, disputed invoices. If there's one bad invoice, the customer might withhold payment on everything until it's fixed. Just knowing our number of days sales in accounts receivable can immediately tell us if there's a problem. Sometimes that number is egregious. We've seen 70 days. This one metric is incredibly powerful. It signals that the company has a serious issue. Let's calculate the actual cost of excess accounts receivable. First, sales per day. 940,000 divided by 365 equals $2,575. Now take 38 days, multiply by 2,575, we get budgeted accounts receivable of 97,850. Our actual accounts receivable is 130,000. Subtract budgeted, and we get 32,150 in excess receivables. Now multiply that by 25%. That's $8,000 in cost. With total net profit of $35,000, that's over 20% of our earnings. In this slide, we're showing our accounts receivable balance of $130,000. This value is critical in multiple turnover and efficiency ratios. Here we show our sales from the income statement, or statement of earnings, $940,000. Now we're turning our focus to accounts payable. Specifically, we want to compare accounts payable to cost of goods sold. The goal? To determine how many days of purchases are owed to suppliers. This is called number of days cost of sales in accounts payable. Let's calculate the number of days cost of sales in accounts payable. We take accounts payable of 60,000, multiply by 365, then divide by cost of goods sold, 620,000. The result is 35 days. The standard is 32 days. This isn't based on the clothing industry. It's a general financial standard based on the idea that most vendors extend 30-day terms. Our actual 35 days is reasonably close to standard, but we could improve slightly. Paying down $5,000 in accounts payable would bring the number to $55,000. Then 55,000 times 365 divided by 620,000 equals 32 days. That said, we've seen companies with 60 days in accounts payable. That one metric tells us they're low on cash and unable to pay their bills on time. Here, we show the section of the balance sheet with accounts payable, $60,000. Here, we show the income statement, specifically the cost of sales, $620,000.